sometimes I talk about mortgage, which is my expertise, and sometimes I talk about other people's arenas. But today we're going to stay in my arena and talk about mortgages. I want to talk about creative financing, or I should say a little bit out of the box that you may think would have some challenges, and just understanding how the mortgage industry works, and to know that it isn't always a no because of the fact that there are alternative options. And here's a question that you really want to look at when looking at your mortgage professional. Make sure that they are direct to Fannie Mae and Freddie Mac. Ask if they have any overlays to Fannie Mae and Freddie Mac guidelines. Do they have access to government financing? And do they have a portfolio channel? So outside of Fannie Mae and Freddie Mac guidelines, if there are sometimes overlays where lenders will put additional regulations and rules on top of what the secondary Fannie Mae and Freddie Mac have set up. So that's why you want to avoid that. Government financing, making sure that they have access to FHA, VA financing. Portfolio channel is just where things are a little bit out of the box that they might be able to put it in and hold instead of selling it on the secondary market. So that's what I want to talk about today. There are more than one way to skin the cat. So let's first talk about self-employment. If you're in the industry, understand mortgages, you may think that you have to have 2 years being self-employed in order to get a mortgage. That is the standard requirements, but that's actually the requirements through Fannie Mae. Freddie Mac does not always mirror Fannie Mae, vice versa. Sometimes they have different guidelines that they have. Freddie Mac actually allows, if it goes through the automated system and gets an accept through what they call LP, for 1 year, you only need 1 year tax returns. So if you just started a business, that can be really helpful for you. What if you took a loss in 2013 or took a loss in 2014 and you've got an extension now to October to do your taxes for 2015? You want to strategize a little bit differently on how you file your taxes for qualification for mortgage. That's an opportunity if you only need 1 year self-employed. So something to look into if you've been turned down for a mortgage because you don't have 2 year full tax returns for your business. Pick up the phone and give you a call because there is options available. Now, new employment during closing. If anybody is out there listening to the show right now and you're in the middle of closing on a home, and you're having some delays or issues because you've changed your job. Now, ideally, you're having this conversation prior to going under contract, but a lot of times consumers don't understand what they can and can't do during the process because they were not educated during the process of what to do. So if you're out there and you are in the middle of employment change right now and you've been asked to delay the closing because of that, you should not have to if you've got a lender that can actually hold the loan before it's sold into the secondary, and if they have a portfolio channel that would allow for to do that. So if you have standard guidelines through Fannie Mae and Freddie Mac is that you have 1 month recent pay stubs in the file prior to closing. But if you have at least a signed contract and you've started your new position, you can get around that. Now, if you're going with government financing, FHA financing, not VA, if you're going with FHA financing, you actually don't even have to have started your position. You just need to have that offer letter. And I should say not contract, but offer letter. It's going to be really specific on what type of employment. I mean, you can't go into a position to where you're a contract employee. It has to be an actual employee of a company to where your salary. So some ways to get around that as well. No money for down payment, but you make too much for a grant. If you have a spouse that's purchasing with you, the most common grant program, or I think the best grant program that's out there that's available, their maximum income restriction is $97,000 a year. It doesn't matter where you're purchasing in Washington State, it's $97,000. So if you earn, as one of the spouse, $90,000, and then the other spouse earns $30,000, you are over that maximum $97,000. But did you know that you can actually, if you choose the right grant program, you can leave off the spouse that makes the $30,000 to now qualify, because it's not a household income, but it's an individual based on who is on the loan application. Now, you do want to talk with a real estate attorney, see how that's going to affect if you want to make sure you're taking title correctly. So I don't want to get into that piece of it, but I'm just on the financing piece of it, of a way to get into a program that might be something that you want. Now, what about too high of a debt to income ratio? You've probably heard me, if you're a regular listener to the show, you've probably heard me talk about the MCC Mortgage Credit Certificate Tax Credit, a 20% credit that you have on your interest for the life of the loan. Qualification's a part of that, but I'm going to talk about the income qualification. Now, unlike the grant I just talked about, this is household income. So the entire household cannot make more than $97,000, depending on the county that you're purchasing in. So it's based on county on this program. But you want to make sure that your lender will actually utilize that 20% tax credit to go towards your income qualification, because not all lenders do. So there's some creative options around that to utilize that 20% tax credit for qualifying. Now, what about purchasing a property as an investment property? Did you know that you can actually use 75% of the potential rent income? You don't have to have a tenant. The appraiser is going to do a comparison to see what that market rent would be. And 75% of that can be utilized if you're purchasing an investment property. You do not need to have 12 months rental history in order to qualify for this. Now, you also, if you're buying an owner-occupied property and are having some challenges in qualifying, or a second home property, you can actually go in and purchase it as an investment property. There is nothing wrong with purchasing it as investment if you're going to be owner-occupying. On the other side, you cannot purchase an owner-occupied property if you're going to invest. Totally different scenario. But if you can't qualify as an owner-occupied, if you're purchasing it as investment property, now you can use that 75% of whatever the potential rent would be to offset the mortgage for qualification. What about spouse contributing towards the down payment if for some reason they're not going to be on the loan? You can utilize the spouse's bank accounts for down payment to purchase your home. Now, I'm kind of jumping around with some different creative and different options because there are a lot of things that fit in one category that can qualify and come together in another category. So I'm just having you think about things that might come up that can be an option for you. Now, FHA government financing, a lot of lenders will have a 660 minimum credit score, maybe a 620 minimum credit score. Those are overlays. FHA is there's an actually low FICO score of 580. So if you have a 580 FICO score and you qualify for FHA financing, that's an option for you. Now, funds to close. There's a lot of challenges and inconvenience with paper trailing funds to close that you're utilizing to purchase your home. Anything that comes into your bank account has to be verified and documented where those sources come from. Fannie Mae has actually just made updates to their guidelines and requirements that if it's under 2% of the purchase price, it doesn't have to be verified. That's going to be huge for some of you out there. Last one I want to go over before we take to break is more than 10 properties. So here's another common one, that thinking that you can't have more than 10 properties financed. You can. There's some alternatives and some options around that. Actually, I do want to touch on one more, condo occupancy requirement. Really common to think that you need to have a 51% occupancy requirement. So if you're purchasing a condo, 51% of the units have to be owner occupied. That is not the case if you're purchasing this condo as a primary residence. It's only if you're purchasing as an investment property that there has to be 51% owner occupied. So just some little teasers out there. There's many more. If you have any challenges with your financing, a call to action is just to pick up the phone and give my show a call. 1-855-400-1150. Again, 1-855-400-1150. Just run it by and see if there's some creative options out there for you. Coming up next in the Money Hour, real estate owned and estate planning, Anton Cawthorn with Reberg Law Group right here at 1150 AM KKNW after the short break.